Hello everyone, this is Professor Kent. Today's recording is chapter 1 for income tax. So first chapter is all about theory, and then we're going to go into doing the questions or the examples. Chapter 1 is all about theory. Of course, we don't like to learn theory, but we have no way of avoiding the theory. When we think of a Canadian income tax system, it's an introduction to Canadian tax system. What we're doing is we're learning and understanding the Canadian income tax. Of course, it will be different from the other countries. We have to answer 3 questions when we're talking about Canadian income tax. Who is required to pay the income tax? How is income tax payable determined? How do we calculate how much taxes to pay? When and how does one go about paying this income tax? If we owe money, how do we pay to the government? That's what it means. So let's answer the first question, and then we'll go to the second and then the third question. Our first question is, who's required to pay the income tax? The residents of Canada. So if you're residents of Canada, you are required to pay income taxes at the end of the year. And if you're a non-resident of Canada, so if you're a resident, you pay taxes. If you're non-resident, you also pay taxes. When you're non-resident, if you earn a business or an employment income in Canada, or you have a gain on disposition of a property, so you have sold the property and you have sold it for more than what the property was worth, you have a gain and you are a non-resident. If that happens, you have to pay the taxes on the gain that you occurred from selling the property. Going to the second question, how is income tax? How do we know how much income tax to pay? So there are 4 steps to follow. Our first step is we add all the income. So the word here is all the income, and deduct all the available expenses. You have income, so you deduct the expenses, and that we call it a net income. Then my second step is to calculate the taxable income. First step was to calculate the net income, and then the second step is to calculate the taxable income. Your liability, your tax liability depends on your tax payable. Either you pay the government or you get a refund at the end of the year. Now, number 3 is gross tax. Apply various tax rates to the taxable income. Depending on, we're going to talk about a little bit later on but at this point, depending on your taxable income, what we calculate what rate you are going to be, and that's how you calculate your gross taxes. Once you've done your liability, what we needed to do is we're going to calculate any tax credits, and we subtract it from the gross tax. Is either we have a positive number or we have a negative number. If you owe money, then it will be a tax payable, and if you're going to get a money back, we call them a refund from the government. You either pay or you refund. Our second question is, how do you, once you know you pay, if you know that you have a tax payable, you have to pay to the government. If it's a refund, the government is going to pay you, and they're going to send you a check if you owe money. So what we needed to do is, in order for us to, how does one go paying the income tax? We have to file it. You have to file an annual income tax. So if you owe money, you should file it, because otherwise the government is going to assess you if you owe money. But if you don't owe money, government doesn't. It's up to you to file the taxes and get a refund and get all the benefit that you're supposed to get. If you don't file your taxes, they're not going to assess you. But if you owe money, they are going to assess you automatically. Now, there's 2 methods of when we do accounting. One is an accounting and one is for income tax. They both are different. When we think of a income tax concept, they're not based on accounting concept. Accounting, we do accrual. When we do income tax, we pay on the cash basis. That's what it means. So income tax is paid when we calculate our taxable income. Taxable income is produced using the Income Tax Act. So we call it Income Tax Act. But if you think of, Income Tax Act, when you think of accounting income produced as a GAAP principle. When you think of a GAAP principle, we call it accrual accounting. So accounting income is created using an accrual accounting. Income tax is normally a cash basis. When we think of it, Income Tax Act, it is based on a legal concept. That's what it is. For example, the determination if an individual is an employee or self-employed contractor is based on the case of law. We want to know if there's a difference between employee, self-employed, there's a difference, and then Income Tax Act will tell you if you classify yourself as an employee or self-employed. Now, ITA, when we talk about Income Tax Act, operates on the basis of other laws such as property, contract, corporate, common law, law of trust. These are some of my, when we think of a tax rate, these are my, if you think about it, these are the tax rates. So we pay personal taxes. If you're a company, you pay corporate taxes. We have a GST. There's the taxes on other revenues. We have an EI, and we have other excise taxes, non-residence tax, and custom import tax. They're all equal to 100%. When we think of in Canada, taxable entities in Canada, who are the taxable entities in Canada? Individual means you and me. If you're an individual, we are human beings, we pay taxes. Corporation pay taxes. Trust companies pay taxes. When we think of a trust, we go to a partnership. Partnership is when you go into a business to do a business together, more than one person. You learn there's three type of corporation. You could be sole proprietorship, when you a single owner, and you could go into a partner with more than one partner in the business. Then we call it a partnership. Partnership is not a legal entity. It's not a legal entity, and they're not taxable. But then we have to, any income that is earned in a partnership, is taxed in the hands of a partner. So if there's two partners, the partnership made $100,000, you're a 50-50 partnership. 50% will be taxed with will pay taxes the first partner. The other 50% will be paid by the second partner. Now going further, forms of business versus taxable entities. So if you're a sole proprietorship, not a taxable entity, but you have to pay taxes. Of course, if you're sole proprietorship, you'll be called a business owner. It is an individual proprietorship, reports business income on its personal income tax. So you will doing a T1. We call it personal tax is T1. If you're sole proprietorship, you still have to pay taxes. If you own a business, and what we do, you're going to put it with your individual taxes. We call it T1. Partnership is not a taxable entity, but you have to pay taxes, and that partnership's income will be part of your T1 as an individual. If you own a corporation, you will be filing a T2, and if it's a trust, you will be filing a T3. Now, personal tax or your first volume 1 of your income taxes all about personal taxes, which is your T1. But if you incorporate your business, then you have to file a T2. So that's what you have to do. You have to report your income, and that income is reported on a T2. Now, some people or some entities are tax exempt, means they don't pay any tax. When we say tax exempt, they don't pay any tax. Who are those? When we think of a tax exempt, they are municipality. You have a city of Toronto, city of Brampton, city of Vaughan. Those are the cities, so they don't pay any taxes. So labor organization, and if you're part of a union, they don't pay any taxes. Any charities such as churches, temples, those are non-profit organizations. And then trusts that are RSP. So what they do is they monitor RSPs, they're trust companies, so they just monitor it. They don't pay any taxes. RESP is a registered education plan. If you put money towards your kids' education, we call it RESP, and they are tax exempt. And also tax-free savings account, we do not pay taxes. So there's a limit every year. You can put money in your tax-free savings account, and you can invest that money. When you invest that money, any interest or dividend earned on that income is called the tax-free savings account. Now what we're going to do is GST is a federal tax. HST, that's what we pay. HST is 5% is your GST, and 8% is your PST. So your GST is your 5%, which is goods and service tax. In Ontario, we pay 13%, 5% is your GST, and 8% is your provincial sales tax. If what we do is this is called the tax collected on the sales of goods by the business owner. So that's what happens. What you do is when you sell something, you have to collect the tax. You're a middleman. We call it, you are a middleman. If you have done Sage 50 or Sage 300 or even QuickBooks, we have a HST payable and HST recoverable. When you collect it, we call it a HST payable. And then when you recover, HST recoverable is on your expenses. That's what you are. So that's you're going to recover that money. So taxable entity for GST and HST. Partnership or charities are not necessarily a taxable entity. So any charities, or if you're in the business of a partnership, are not a taxable entity. So they are not taxable they don't collect HST. Now these are some of the, we did talk about a little bit. In this case, these are which territory. When we think of a province that pays, these are the different provinces, and this is what their rate is that they pay. I talk about Ontario, and we pay 13% taxes. So that we pay 13% taxes. Now there's two type of system when we talk about taxation in Canada. So one is regressive, the other one is progressive. Now regressive is result in a lower effective tax rate as high income goes. If once you're at a higher, of course you reach the higher bracket, it doesn't matter how much more money you make, you're going to be in the same tax bracket. Now the example of that is a sales tax. When you have a progressive personal income tax, apply graduated series of taxes rate to successfully higher income level. So then we're going to talk about different income tax rate. Depending on your income, you are in a different tax bracket. That's what happens. Now, the tax expenditures. Expenditures are the expenses. The government, that's what happened, forgoes revenue through tax breaks, concessions, preference instead of making direct payment. So to the entity select. So such as examples of it, select individuals or groups, examples senior citizens. Certain income tax, we have capital gains. Taxpayer characteristics, those are the people with a disability. So there are some, the government forgoes some of the taxes on the revenue. So these are some of the examples when we think of it. Now, you will be this is just the structure of it, but we're going to learn about all of these sections. Now, when we think of my first tax is your part 1 tax, which is calculated in chapter 1. We call it IT2. It's a liability for tax, so that your tax payable. And we also call it division A. Division B is how the computation of your income. How do we compute our income? So we have an income from different sources. In chapter, there's 5 divisions when we think of it. 1, 2, 3, 4, and 5. My first subdivision is my division A. So what we have, you could have an income or losses from office or from employment. So that your division A is that we're going to be calculating it in chapter 3. And then your division B, we're going to calculate it in chapter 5 and chapter 6, which is an income or a loss from business. A, first one is your income or loss from office or from employment. B is business and a property. C, if you have your gains, you have a property that you sold, you have a gain, and that what it is, we have a taxable capital gain. And then we don't pay taxes on all the gains, and if you have any losses, you are allowed to deduct the loss from those gains. And D is your other source of income. We'll be talking more about it in chapter 9. And then what we're doing is we're talking about deductions. So A and B are, if I were to think A, B, and C are more, we're going to be spending time more on that. Then if we were thinking about A, so if, of course, it is the remaining 6 divisions, subdivision F through K. Now I'm not going to worry about it because we're going to talk about it more into division B and C, and your D, which is non-residences, will be covered in your volume 2. So these are subdivisions, and what we wanted to do is we wanted to go through it as we come to these chapters. Chapter 1 is just about theory, but we're going to go to chapter 3 to calculate income or losses from the employment. These are the steps. First one is, remember we had the four steps that we talked about. First one was the net income, taxable income, gross tax, and then we have the tax credit. And there's divisions under each one. Now we also have something called international tax treaty. We have a treaty with the different countries, and what we're doing is, why do we have it? We wanted to avoid double taxation. That's why we have a treaty. So now we have a treaty with a lot of countries. Example will be, if I were to do with the US, we have a tax treaty with the US. There's a list of countries that we have a treaty with. If you go to CRA site and then you look for tax treaties, and then it will list of the countries that we have a treaty with. So what we have is, the reason why is that we don't want individuals to or business owners to pay double taxation. That's why we have tax treaty. Now, what we have is then when we talk about part 1 tax, we say that who pays taxes? Residents and non-residents. They pay taxes. When we think of a residence, they pay taxes on a worldwide income. If you're residents of Canada, if you earn an income somewhere else, you have to report that income in your taxes. You're paying taxes on your worldwide income. If you are a non-resident of Canada, you only pay taxes on if you were employed in Canada, or if you carry a business in Canada, or if you dispose means if you sold a property in Canada, then you will be paying taxes. Now going further, now when we think of a how do we know if you're residents or a non-residents? Now when we think of it, when you think of a residence, for individuals, the place or he or she calls his home, that will be a residence. A corporation, where the board of director meetings are held. So if your meetings are held in Ontario, your corporation's home is Ontario. For trust, where trustees, you have trustees that manage the trust, where the decisions are made. So if the decisions are made in Ontario, then in Canada you will be a resident of Canada, or that's what happens. Now when we think of a tax payable by person resident in Canada, so what happens is that an income tax shall be paid as required by this act on a taxable income for each taxation year for every person resident in Canada at any time of the year. So a person, when we think of a person is an individual, a corporation, a trust, where those are the persons, and they all have to pay taxes. Now we say taxable income. So tax is calculated on my taxable income. When we have a division A, we have a taxable division A is your net income, and that net income we convert it into taxable income. So to pay taxes. So it's the taxable income for a taxpayer. For a taxpayer is taxpayer's income for the year plus the additions and any minuses permitted by division C. So any divisions that are permitted by division C. When we think of an income, in the book, if you're using a book, we call it a net income. Net income for tax purposes is different from the net income is calculated using an accounting method. So accounting method, which is your accrual accounting, that we convert that into a tax purposes, means that becomes my taxable income. That's what it is. There's a difference between the net income and the income for tax purposes. Like I said, that net income using the accounting method, income for tax purposes using the Income Tax Act methods. Now, when we think of it, we convert the net income into a taxable income. Now, what we think about it, if I were to think about it, if you were an individual or a trust, your year end is a calendar year. So January to December, that's your year end. If you're a corporation, you could have any fiscal years, but it cannot exceed the 53 weeks. That's what it means. It cannot exceed the 53 weeks. When we think of individuals that die, so of course arises at the time of individual's death and can continue for up to 36 months after the death, right? But they use a non-calendar year can be used for estate planning. So now when we think of a part 1 part one, liability for non-residents. So for non-residents, we talked about it before. What they do is they're non-resident of Canada, but they have an employment income they earned in Canada. They have to pay taxes. They have a business, they carried it in Canada, they sold the property, and what they do is they require part one payable taxes. They have a taxable, they have to calculate, they have to file their T1, and then once they do that, they have a taxable income, and they pay taxes on the income they earned in Canada. So now what they do is they are not allowed any taxes. They means it's not available to them because they're non-residents. Tax credit is only available to the people that are resident of Canada. When we think of employment income earned by non-residents while working as an employee in Canada. Example, if you're a US citizen and resident of Detroit, but you start working in Windsor, which is in Ontario, they will be non-resident. They're subject to Canadian tax on Canadian employment income, but they're not taxed on their worldwide income. They're only taxed on the employment they earned in Canada. Business income, person doesn't have to be human. It could be individual or corporation. It says who carries a business in Canada is subject to Canadian tax. Now this is something we call it a factual type of residency, deemed residence, and deemed non-residence. We're going to be talking about that. Now when we say factual residency of an individual, now this is a definition of it, so you can read the definition. Now we're going to say average Canadian individual has a job, family, dwelling place, and other personal property all in Canada, would clearly be a Canadian residence. If you have a family in Canada, you have a house in Canada, you have other property, investment property, or any type of property, you will be a Canadian resident. And then as a result, you will be liable for Canadian taxation, and you will have to pay taxes on your worldwide income. These are some example of your examples what makes you a resident. So if you have a personal property, you have a seasonal, means you have a cottage, you are a landed immigrant or a work permit, you have a health card, you have a driver license, you have a vehicle registration, you have a Canadian passport, or you belong to any unions that makes you a Canadian resident. So now sometimes what you could do is you could be a part-time resident, means now the example will be you are a non-resident individual becomes resident of Canada, means you came into Canada a portion of the year. So that's what it means. Now in that case, your taxation year divided into two parts based on your date of residency. So depending on when you came to Canada, so then taxation year is divided into two because you have a partial year. We call it a partial year residency. Now, what you needed to tell the government when you're a part-time resident, you needed if you could be coming in or you could be leaving. The date individual leaves the Canada, the date the spouse or common partner and or other dependent or individual. So or the date individual becomes residents of another country. So this is what makes a part year residence. So if you decided that you don't want to live in Canada anymore, then you want to go to the US, so you need to provide a date. So that's what happens. Or you decided to the date your spouse or common law or partner and the other dependents of individual leaves the Canada. So what happens is that when we file a taxes, when you do a tax return, you have to see you have a spouse, your spouse leaves, you have to provide them the date. If you have dependent kids, and you have to provide them the date that they left. And then also, if you become a resident of other country, and then you have to provide them the date. Individual, now you could be leaving or you could be entering the Canada. So individual becomes Canadian resident on the day both landed immigrant or status and provincial health card is obtained. So you get a health card or you become a landed immigrant, you have to provide them the date on your income tax return when you file a tax return. You will be taxed on your worldwide income for the entire taxation year. So that's what happens. So then you will be paying taxes. Sometimes we call it deemed residence. Then when you do that, deemed residence is you leave, you come back, you leave, you come back, but you were in Canada for 183 days. If you were in Canada for 133 days, you becomes a deemed residence, you pay taxes on the worldwide income. So now what happens in this case, deemed residency of corporation. So these were it goes under ITA 250. So that's what happens for it to be deemed for a corporation to be a deemed residence. If you becomes a reason if one of the two tests are met. My first one, anytime after April 26, 1965. Company either carried on a business in Canada. If you carried on a business in Canada, you meet the criteria of a residency for the corporation. Now, which was a factual resident of Canada because CMCA in Canada. So what happens is that one or the other, either you carried a business in Canada or you became or the business was a resident of Canada, then it becomes a deemed resident. So this is the summary of it. These are the taxes: A, B, C, D, and T, E. So if you think about it, I always say C has capital gain and losses. When you think of division A and B has all the income. You have an employment income, you have a business income, and you have a property income. Division D is your other income, and E is your other deductions. When we think of net income, now the word here is income. We only deal with positive numbers. We only deal with the net incomes, in other words. So income is a positive concept. And when you think of an income, the company made an income. That's what there's no negatives in there. We ignore any negatives. So if it's a negative results, what we say you will have a zero income. What we have is reference to employment, business, or property is a net concept. You have a gross income minus any expenses. You will have an income, and then if you don't have an income, like we said, that you cannot have negative numbers. And you learned about net losses. So when you think of this income, we think of a positive numbers. In that positive amount, we have an income from employment, you have an income from business income, you have an income from property income. So that's what it is. So it does not, it does not include any losses from employment, business, or property. It does not. Now, when we think of the income, what we're doing is we are allowed to allow some deductions. What are those deductions? Those are deductions that are allowed. First one is moving expenses. If you move from one province to another province, that is called a moving expense. You have children and you pay for child care expenses. You contributed to your RRSP contribution, or spousal amount is paid. That will be it. It will be a positive or nil. It cannot be negative. So you have an income, and what you're going to do is you are going to minus these. You're going to minus it. You are going to have a positive number. If you have a negative number, we treat as a zero. We treat it as a zero. But if you have a positive number, we're going to be calculating our taxes. They said that if it's positive, then we have a net income. If it's not positive, it is a negative, then we call it a nil. So your tax liability will be nil. That's what it means. Now, what is included in my employment income? And what happens is that you work as a salary, you earn hourly wages, you have stock options or any other benefits that your employer gave it to you. That is called an income. So we call it employment income. So that is all goes into my employment income. I'm allowed to deduct. So you're allowed to deduct any automobile or home office expenses that you generated to earn that salary, or to earn those benefits. You're allowed to deduct that. It is only applied to the individual. Of course, the employment income only allowed for individuals. It's never negative. So it is never negative. So mostly you earn income, and income is a positive number, and you are allowed some deductions. That will be employment income. You also going to have a business income, or you could have a business losses. So now if we were to think of a business income, how do you calculate the business income? If you carry a business, such as you're going to have a sale on a product or a service, so minus whatever the expenses you have. So when you do that, you have a business income or a business loss. So either you have an income or you could have a loss. Applies to individuals, corporations, and trusts. When we think of a property income, you have an income, you're holding a property, such as you're holding a property like an investment property. You are getting rent from that, or you have shares in a company, they pay you dividend, or you put money in the GIC, you get interest. So these are the incomes, and what you do is you're allowed to deduct expenses to earn that. So in other words, you have a rent income. So you also, maybe your tenant is not paying for utilities for that investment property. You're allowed to deduct that. Or if you have a mortgage on that, the interest on that mortgage is also a deductible expense. Again, it applies to individuals, corporations, and trusts. Next one, we talk about capital gain and capital losses. So we call it capital gain and capital loss. When you sell a property more than what the cost is. So your cost was, let's say, $10,000, but you sold it for proceeds was, let's say, $8,000. So what we have is, we call $2,000, we call it a capital loss. When we think of a taxable, in this case, we do multiply by half, will be a taxable loss. Or the other way will be 8,000 was a cost, 10,000 we sold it for more. In this case, we have $2,000 and we could have a capital gain. So you could have a gain or taxable or a loss. So half of it will be a taxable. So when we think of it, we only pay taxes on 1,000. If you have a loss, we only have losses of 1,000. Now I highlighted it here. I showed you how allowable capital loss. So if, for example, I change this question, I'm going to say that I sold it for, let's say, $12,000. So my gain is $4,000. My taxable gain is $2,000. So from one property you have a gain, from the other property you have a loss. So when you are allowed to deduct the loss of 1,000, and then what you're going to do is your taxable capital gain that you will pay taxes on $1,000. So that what happened, allowable capital loss exceed the capital gain. Then what we do is, if your losses exceed, what we do is we carry forward those losses. You carry forward the losses. So in this case, we don't have any carry forward. Our gain was 2,000 and our loss was 1,000. So what we have is we have a taxable capital gain, and when we have a gain, we pay taxes on it. But if you have a taxable losses, you carry forward. You only it only applies up to the gain, and then what we up to the tax, if allowable capital losses exceeds taxable capital gain, it can be claimed on the other years. By other income, now the other income, as an individual, you could have a pension income. If you retired, you're going to have a pension income. Your spouse could be paying you spousal benefit. You could, if your income is low, you get a social assistance payments. So, and these are some of the deductions that you're allowed. We talked about it: RRSP, child care expenses, moving expenses, the spouse support that you paid. So now this is a good chart. It tells you everything that we talked about it in order for us to calculate my income. So of course we start with the income from different sources and then come up with the net income that we have. So you have A, B, C, D. These are my divisions. When we had, this is an example. So first one we have this is, if this table, whatever this table is, we're going to do it in an example. As an individual, you work, so you have an employment income. You also have a business that you carry as a self-proprietorship. You have a business, so you have a revenue, you have an expenses. What we have is, you didn't make any income, you have a loss, and what happens is the loss is treated as a negative. You have we call it taxable capital gain. In this case, the company might have $14,000 capital gain, and then the taxable capital gain of that is I multiply by the half, and that is my taxable capital gain. And I could have a capital losses, in this case 20,000 allowable capital losses. When these are my allowable. And how do I calculate my net income? So if I were to do that, we say that, how do I calculate the net income? So when you have an income, you're not allowed any negative. If you're not allowed any negative, we replace the negative into a nil, or you could make it as a zero. So there's no zero. So any negative numbers are ignored or replaced with the zero. So like I said, that we have a capital loss and a capital gain. So my loss was $20,000 and my gain was $7,000. So I don't pay any taxes. And what happens is, the rest of the amount, what do we do with it? Of course, it'll be carried forward. My loss is $13,000 will be your carry forward. So let's go further. So now what we have is that we have taxable capital gain was 7, in this case $20,000. We will not pay any taxes on the capital gain. The reason why we don't pay any taxes on it, because what happens is what we do is we are deducting 7,000, and that becomes the nil amount, so we don't pay any taxes. So if you look at it, this star goes here, the other 13,000 is carry forward. Now we have they told us in the question, we have a sale and then we have a business loss. So we have a business loss. When you have a business loss, is minus from the income. In other words, this number cannot be nil. So this number cannot be nil. So it's never nil. That's what it is. You cannot have a nil number in your net income. You're allowed to do the deductions. So the next what we're doing is tax avoidance. So what happens is, if permanently avoid payments of some of the amounts. So what happens in this, you have limited possibility to do that. You have a capital gain deductions on a disposition or qualified farming income or fishing property, or qualify as a small corporation. Now we have a small business deduction, I don't want to talk about it now. We call it SBD, and you will learn it later on in the chapters. Some of the tax avoidance will be healthcare. So the employer provides you a free tax-free health care, so dental, glasses, something like that. So those we don't pay taxes on. Employee discount, you work for a company, let's say Adidas, and then they pay you, they give you some discounts, and you don't pay any taxes. We can defer our taxes by contributing to a registered pension plan, or what we could do is we could defer our taxes by using a CCA on a rental property to reduce your rental income. You could defer your taxes, but we have to pay the taxes regardless of it. If you are in a higher tax bracket, you could do income splitting. So you could split your income with someone else. So what happens is, taxable income allocated to 2 or more individuals, usually a family member. So that's what happens. So sometimes we don't want to do that. Why do we don't want to split our income with your spouse or with your other family members? Because you will lose control over the asset. That's the first thing. You don't want to do that. Split income decision as to how much or which family member are worthy of receiving this benefit. Sometimes every family creates a fiction, then it creates a problem for the family. Like I say, that we have to treat everybody same. If you give split income, you give them part of your assets, you lose the control and also create a problem. So this was my last slide. We're done with the chapter number 1. The main question will be, in this case, the main question is, from this chapter is, from this part, your taxable capital loss and allowable. How do we calculate the carry forward? And the other one will be, the question will be, how do you calculate your net income? And also the question will be asked, what makes you resident and what makes you non-resident of Canada? So those are some of the questions that can be asked from chapter number 1. Thank you for watching. Please don't forget to subscribe to my channel so that you get access to the new video that I post. Thank you so much for listening to me. Take care and bye for now.